This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 11, 2026, and this is the After Hours session. Now, let's get into it. The Russell 2000 is hovering at $299.98, staring down its own 5-day low, while the SIBO Volatility Index sits comfortably at a complacent 14.9. That is a textbook divergence. Price action screaming risk-off, while the market's internal gauge of fear remains asleep at the wheel. Today, we dissect why this fragile rally is fraying at the edges, with energy outpacing tech and small caps facing a structural test. Looking ahead, the immediate landscape is shaped by earnings releases for AX, AL, and AII today. We also watch the post-earnings fallout from ANAN and EVC, which saw double-digit percentage drops despite mixed fundamentals. The broader macro backdrop features a Fed funds rate of 3.63%, with core PCE stuck at 3.29%, meaning the inflation overhang hasn't gone away. It's just being ignored by the VIX. Here is the snapshot as of 16:35 ET. The S&P 500, tracked by SPY, is essentially flat at $773.03. But look closer. The Nasdaq 100, QQQ, has slipped to $720.87, down minus 0.3%. Meanwhile, the Energy Select Sector SPDR, the energy sector, has exploded higher by plus 4.66% to $60.18. The yield curve is steepening, the dollar is holding firm, and the market is quietly rotating out of growth. Let's get into the data. Let's start with the broader market structure, specifically the tension between the S&P 500 and the Russell 2000. Grid, you've got the charts. What is the technical reality right now?
We are seeing a classic compression squeeze in the S&P 500. SPY is trapped between its August 10 low of $771.62 and its August 10 high of $775.05. It's sitting at $773.03, which is right in the dead center of that range. It looks stable, but technically it's coiling for break. The danger isn't SPY though, it's the IWM. The Russell 2000 is at $299.98, which is less than $1 away from its critical support at $299.08. Once that level goes, we open the door to $297.95. The structure is brittle.
And let's not forget that the VIX is at 14.9. That number is a liar. It tells us the crowd feels safe, but the price action in the IWM, down minus 0.52% today, is telling us they're already packing bags. You're watching the wrong index for the point of failure, grid. The SPY is propped up by megacap weighting. The IWM is where the rot is visible.
I'm tracking the mechanics pulse. Mechanics don't care about your sentiment score. The mechanics show that QQQ rejected resistance at $724.67 and closed at $720.87. That's a bearish reversal signal for tech, and the IWM is testing a support level that is held for 5 days. If it breaks, it breaks. Simple as that.
It's not simple, it's symptomatic. The VIX staying at 14.9 while IWM tanks is a complacency trap. Options traders aren't hedging. They think this is a normal pullback. But when the VIX finally expands beyond its 5-day high of 18.43, the IWM doesn't just dip, it collapses. You can wait for the technical break, or you can acknowledge that the fear is already priced into the small caps, just not the options market. So we have a divergence. Tech and small caps are weakening, but energy is surging. CIPHER, let's talk fundamentals. Is this the energy sector move justified, or is it a distortion?
It's a rotation into value driven by a fundamental decoupling. Look at the hard data. Real GDP is only 1.5%. Non-farm payrolls missed by minus 23K. Yet we have core PCE at 3.29% and CPI at 3.46%. The economy is slowing, but inflation is sticky. In that environment, you don't buy future growth, you buy present cash flow. The energy sector is up plus 4.66% to $60.18 because energy companies have balance sheets that work in a high inflation, slow-growth world. Meanwhile, the technology sector, the same company, essentially, is down minus 0.88% to $186.32 today, reversing a plus 4.65% weekly gain. The market is voting with its wallet. Growth multiples are too rich for this economic heir.
And that's where the risk hides, CIPHER. You're focusing on the numerator, cash flow, but you're ignoring the denominator, rates. The 10-year 2-year spread has steepened to plus 0.47 pp. 10-year yields are at 4.72%. When long-end yields rise, duration-heavy assets get crushed. That's why the utilities sector is down minus 1.1% and the real estate sector is down minus 1.29%. The market knows that 1.5% GDP growth can't sustain 4.7% bond yields forever. The energy breakout isn't a sign of health. It's a hedge against the very real risk that the yield curve keeps steepening, while equities refuse to discount that reality.
But SPECTER, the steepening curve usually helps banks, right? So why isn't the financial sector moving? The financial sector is only up plus 0.36% to $57.81. If the curve were truly boosting the banking sector, we'd see it. Instead, we see a stagnant S&P. This suggests the market is pricing in a soft landing that isn't happening. The energy move is isolated liquidity, not a broad-based bullish conviction.
Let's zoom in on the specific risk flags. Grid, you mentioned the IWM support at $299.08. If that breaks, what happens next?
If IWM closes below $299.08, the technical thesis shifts from consolidation to breakdown. The next structural support is $297.95 from August 6. Below that, you hit $297.22, the August 4 low. There is no cushion here. The volume in distressed names like Sion and Tanks is extreme, 37.8 million and 63.9 million shares respectively, which tells me there's active dumping or short covering noise at the bottom. It's messy. But for the IWM, the $299.08 level is the line in the sand. A break there accelerates the exit from small caps.
And here's the kicker. The VIX at 14.9 means nobody is buying puts to protect that $299 level. Everyone is assuming it holds. That makes the break violent. When you have zero hedging in place for a support level that's been tested for 5 days, the drop isn't gradual. It's a flash crash of illiquidity.
Exactly. And remember the utilities and real estate sectors. They are rate-sensitive proxies for the broader market's tolerance for yields. If IWM breaks, and the real estate sector is already down minus 1.29%, the correlation becomes undeniable. The fragile rally is built on the assumption that yields stay contained. They won't. The steepening curve is a leading indicator of margin compression for those small caps Grid is watching. Their earnings power is being eroded by financing costs, which is why the fundamental quality is dropping even before the chart breaks.
Let's pivot to the technology sector, specifically the triple Q rejection we saw earlier. Triple Q is at $720.87, having failed to hold above $724.67. CIPHER, how do you read this reversal after a plus 4.65% week?
It's a profit-taking event masked as weakness, but the timing is telling. The weekly gain was plus 4.65%, but today's minus 0.88% drop to $186.32 for the technology sector shows that buyers vanished at the top. This isn't just technical, it's fundamental exhaustion. Tech earnings have been priced for perfection, with GDP growth at 1.5%. Consumers aren't spending enough to justify those multiples. The quality in tech is drying up. Look at the individual names. Anon dropped minus 18% and EVC dropped minus 16.1% despite relatively solid reports. Investors are bailing on anything that isn't an absolute certainty, so they rotate into energy, which has tangible assets, and away from tech, which has only promises.
Sentimentally, it's a shift from greed back to caution. The news sentiment for big tech names like MSFT and NVDA is still positive, but the broader market reaction is indifferent. Tesla and Apple are showing neutral to negative sentiment. The crowd is realizing that the Magnificent Seven can't carry the whole index anymore. The low VIX is keeping the panic button quiet, but the smart money is quietly reducing exposure to growth. They aren't selling everything yet, they're just trimming. And trimmings become dumps when the VIX wakes up.
Trimming is exactly why the technology sector is down while the energy sector is up. It's a relative value trade. You go long energy because it's cheap on cash flow, and you short tech because it's expensive on growth. The triple Q rejection at $724.67 is the signal that the relative value trade is working. The yield curve steepening hurts tech's discount factor more than it hurts energy's commodity pricing. That's why the rotation is so clean. It's not random noise. It's a math problem solving itself in real time.
Apex, bring it home. How do you synthesize this? We have a flat S&P, a breaking IWM, a breaking triple Q, and a surging the energy sector, all under the mask of a low VIX. What is the strategic read?
The strategy is clear: avoid the broad market entirely. The SPY at $773.03 is a distractor. It's being held up by a handful of megacaps while the breadth deteriorates. The data points to a stagflationary friction regime. GDP is 1.5%, inflation is 3.46%, and yields are 4.72%. In this mix, you want assets that benefit from inflation and survive higher rates. That is energy and healthcare. The energy sector is up plus 4.66%, and the healthcare sector is up plus 1.67%. These are the winners.
I'll add that if IWM does break $299.08, the speed of the move will likely exceed the SPY's ability to defend $771.62. Watch the IWM volume. If it spikes on the break, the contagion hits the broader index quickly.
Agreed, and watch the VIX. If it ticks above 15.5 while IWM is falling, the complacency is officially over. That's your trigger. We'll leave you with that. Key takeaways. First, the S&P 500 is range-bound at $773.03, masking a deeper divergence in market internals. Second, the Russell 2000 is testing critical support at $299.08, with a break opening the path to $297.95, signaling stress in small-cap liquidity. Third, the rotation is firmly into energy, with the energy sector gaining plus 4.66% to $60.18, as investors flee rate-sensitive tech and growth sectors amid a steepening yield curve and sticky inflation. Tomorrow, we monitor the follow-through on ANAN and EVC and watch for any expansion in the VIX beyond its 5-day high of 18.43. This is ShadowQuant Equities Edition. Stay sharp. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.